Hello and welcome. My name is Sergio Marrero, and thank you for joining us for Rebel One Live, where we're accelerating impact investors and founders. Today, we have a special guest, Jeremy Neilson. He is co-CEO of Assure Services. They're the world's largest administrator of VC funds. He's the former managing director of Utah Fund of Funds and managed Utah's $300 million private equity program. A lot of money. He's a graduate of Brigham Young University and also got his JD at Wake Forest University and also a Utah native. So welcome, Jeremy. Thank you for joining us.
Thank you. Glad to be here.
Yeah. So beyond what I mentioned about Assure, can we dive in and can you give the audience a little bit more color on what is Assure?
Sure. So Assure is a fund administrator kind of at a very high level. But on the detail side, we are kind of the next generation and innovator in fund administration. One of the big parts of our business is SPV fund administration. And I think we'll dig into that a little bit further, but kind of the soundbite is compared to traditional efforts and traditional costs and processes, we have decreased the cost to do special purpose vehicles to invest in private assets by 90%. And we've increased the speed by 90%. So we've taken this old model of piecing together law firms, accounting firms, tax firms, administrators, internal team. We've bundled it into a product, and you can just come to us and get all your SPV and fund administration needs that you want and need for one flat fee price. And we've become that expert.
That's great. And to give the audience a little color as well, I think I think some people may see fund administration or accounting and not say, okay, this isn't as sexy as venture capital. But if you're thinking of starting a fund, you're going to need to talk to Assure or someone like Assure to make sure your fund is operating. So it is sexy. It's there's a lot going on, and the innovation that I would say the innovation that Assure has been doing has really pushed the industry forward and enabling people to make smaller investments, smaller size investments, more people to get into the game. So excited for you to give more color around that and talk about how you got there. On that note, can you share more about your background and how you ended up to be CEO of Assure?
Yeah, so before I jump into that, just kind of playing off what you said, if you do invest in private assets, startup companies, real estate, whatever it is, if you don't go direct by way of just calling the CEO and taking money out of your pocket, you're going to be going through a structured vehicle. And what's been holding back the industry for many years is the cost and slowness of structuring vehicles in order to put together that vehicle so that you can invest in startup companies or whatever other asset that you need to and want to do. So how I got started was, it kind of goes back to my background of going to law school. Went to law school and then went to the University of Utah for an MBA. And while I was there, I joined a student-run venture capital group, right? As students, you do some research and talk with venture capitalists and try to help them, generate some reports or just help them do some due diligence. A lot of it was them helping us. A little bit was us helping them. And from there, the Utah Fund of Funds legislation was passed. And I was very, very interested in startups and the venture capital world. And so I was very eager to win that job. And my law degree basically won me that job. And so I spent the next 7 years working with venture capitalists and startup CEOs. So kind of half my day was listening to fund pitches. So venture capitalists, buyout, mezz, energy, distressed, whatever it is, we would listen to their pitch about investing some of our $300 million into their fund. And the other half of the day, I met with CEOs because of the economic development nature of it. I wanted and needed to help them get access to alternative capital. So I'd visit with companies, and then I'd turn around and make introductions for them to these different groups that I'd been meeting with. So really wanting to do a great job on great returns and do a great job facilitating introductions, growing Utah's economy. The program was successful, but as all state programs kind of go, gets political, gets kind of sideways. It went sideways on me. I was asked to depart. I did so, and then spent the next 2 years trying to kind of create Assure. Failed at some different ideas, failed at a lot of things actually. Tried to do my own fund, failed at that. And then the SBA called, or we applied for an SBA RFP, where we won the mandate to do the due diligence for their $1 billion early stage venture capital program. So that's kind of how we got started, is we worked with the SBA. And then I started to create some of my kind of back office services products, worked with some venture capitalists on a fundraising. And then AngelList called and they said, hey, with the new Jobs Act and some no action letters, can you figure out how to do funds in bulk? And so I was not envisioning this product or Assure in this way. When I left the Utah Fund of Funds, there was a couple things that I knew were keeping the industry back. One of them was structuring. And what I mean by that is, when I left the Utah Fund of Funds, the only way to get into private assets was to go direct or go into a venture fund. And there was a lot of dissatisfaction with venture funds. You write a big check, let's say, minimum's $1 million or 5 million or 10 million. And then you just sit there and you watch, and you really don't have any control or any rights or anything to get into these deals or learn these deals or double down with deals. And so that was really your only access. Or you could kind of build an entire kind of venture capital firm inside your family office or inside your pension fund. And so that was happening occasionally, but there's this tension between the old guard or the old structure and what people really wanted. And so that was curious to me, but I wasn't necessarily smart enough at that moment to like figure out what that meant. And so when AngelList called and said, can you figure out how to do this? I'm like, yeah, I can figure this out. I have a law degree. I understood these documents. I understood the industry really well. And we got off to the races. My co-founder and I, my co-founder basically figured out how to do our back office, track all these funds, make sure all the payments are done. I went forward and figured out the legal side, the product side, the security side. And we started to do deals for AngelList. And then just like, I don't know, a couple of weeks after we started with AngelList, Seed Invest called. Mm-hmm. And after that, the phone just kept ringing, and we've just grown and grown and grown. And it's kind of one of those things where you kind of know you have something when you do zero marketing, zero sales, no marketing at all. We didn't even have a website for the main entity that we were using that was showing up on everybody's documents. And the phone just rang and people just called. And so we figured we had something that the market really wanted. And we just kind of continued to innovate and grow from there.
That's great. It's like the Stripe of the funds.
Yeah.
That's what you're making a turnkey. I love it. And also that story of, you don't know you don't know until someone calls and you take a step in that direction and you realize some of what's there. That's fantastic. Did you, and as you were going through the journey, and thanks also for sharing in the beginning, there were some other ideas that you tried that may have not worked out. What were some of those early ideas, if you don't mind sharing?
Yeah, so a lot of it came out of the Utah Fund of Funds structure. So the Utah Fund of Funds was very innovative around kind of tax credits and using kind of a public-private partnership. I was able to develop some pretty sophisticated models around how to take, let's say, capital and really decrease the risk of failure, increase the probability of strong returns while helping whatever the cause is, economic development or some sort of type of investing. And the model was well tested, but it was just very difficult to get municipalities or states or universities or anybody to really, take that leap. So that was one failure. Another failure was I wanted to do my own fund of funds, implementing kind of my strategy. That was another failure. trying to become the kind of the administrator for other state programs, other state Utah Fund of Funds type programs. I felt that it wasn't until the SBA product that I really kind of got my first win, and then I went in house with a small hedge fund here in Utah, and kind of figured out some of the other products that I could develop. I left them after a few months and launched our first product. Got my first client probably 2 years, almost 2.5 years after I left the Utah Fund of Funds. So I had a healthy drought of success, lots of failures, but ultimately prepared me for the Angelus call. Doing that Assure Fund of Funds, that I called it, and the failure there is when Angelus called, I had already done a fund. I just finished doing one. I'd set one up, walked through the entire path. Although it was a failure, it was kind of really fresh in my mind. And when they said, "Can you figure this out?" I said, "Yes." I didn't really know exactly what I was saying yes to. I just knew that I could figure it out. So a lot of those failures set me up for that moment. It's kind of like that luck, or do you believe in luck? It's like, absolutely. But I'd been preparing myself for that phone call.
Yep, absolutely. And did you think was that your strategy when you went to law school, that you would use it in this way, or what were the thoughts there?
So when I went to law school, I wanted to do a JD MBA. I just did it the hard way. I wasn't accepted into the MBA school because I'm terrible at math. I can figure out math, but I'm not a natural. And so I'm much more of a natural on the law side, the writing side, the analytical side, the strategy side. And so I never thought about myself being a lawyer at a law firm. But when you go to law school, that's all anyone talks about. Now, go to this law firm. This is a great law firm. Look how much money you can make. I got kind of wrapped up in that for the first year or two, but I realized pretty quickly that although I liked the law, I did not want to be a lawyer at a law firm and do that day in and day out. And so one of the unique things about my background, and one of the unique things about launching Assure, was that I was a lawyer, but I wasn't someone that had spent a lot of time in a law firm. And I think the reason why that's important is because when you work at a law firm, I'm going to use a strong word, which is indoctrination. You kind of get indoctrinated about billable hours and the value of your time, and track your time. And when we launched Assure, we just did a flat fee. We just said flat fee. If it takes me 100 hours and I'm making $1 per hour, that's fine. Because what we were trying to figure out, and which we eventually did figure out, is how to scale this thing. How do we figure out that this takes too long? So what do we need to do? Process, technology, build our own technology, find somebody with some technology. How do we take all the parts and start to cut them up and figure out a way that we can basically remove most of the work and effort in all of these pieces? And that's what's somewhat the unique piece of Assure, is we've taken extremely difficult, extremely kind of traditional stuff, and we've cut them up. So we basically have to understand the law with regards to security law, filing security laws, fundraising, accredited investors, investor limits, international law. We have to figure all of that out. We have to understand how to do security filings, blue sky filings. We need to know the taxes. We need to know all the post-close activities and the legal behind that. We need to understand how to do distributions in an efficient manner, cap tables, KYC, AML, on and on and on. So all of these things, each one of them is quite meaty and takes time. And so, just initially, we're just like, we don't care what it costs. We'll just figure it out. We don't care how long it costs. Here's a price. Let's see if it works. And frankly, I underpriced it. Early days, after about 3 months, I had to go back to my clients and say, I've underpriced it. I guessed wrong and I need to raise it. And they let me raise the price and move forward from there. So we just really took it at a startup approach that says, we're going to figure this out, and we're not so concerned about profits today. We're concerned about scaling it so we can gain profits later.
That's great. And I want to dig in also to, for those that are watching that are not familiar, the Jobs Act enacted in 2016 and enabled crowdfunding, and also beyond that, outside of the Jobs Act, the movement of cryptocurrency. Can you speak to what Assure does for platforms that are enabling crowdfunding, and then also cryptocurrency, and how you're interacting with funds dealing with cryptocurrency?
Yeah. So crowdfunding, and I want to make a quick definition here. So there's equity crowdfunding, which is what Seed Invest and PropelX and FundRx, I mean, all these other groups do, and all of our clients do for the most part. That is when you're raising money from accredited investors. Then there's kind of what I term as true crowdfunding, which is this Jobs Act. It's Reg CF, Reg A. And that is when you're raising money from non-accredited investors. What Assure does in that space is we basically prep companies' books so they can fly through the approval process and be at the finish line of raising money much, much quicker. So crowdfunding is highly regulated, where the government is wanting to protect non-accredited investors. And so they've added a number of hoops or a number of very high hurdles that makes it difficult. So you need to either have a broker dealer associated with this or an approved platform. You need to have an accounting firm to do basically qualified opinions or audits. You need to have a law firm, a formal law firm, to provide opinions and fill out forms. And so Assure is none of those things. And so we are kind of on the edge of true crowdfunding services. I hear there's legislation to change that and allow for SPVs to be used, but today they're not allowed. You can't aggregate them into vehicles. And so we are around it, but we are not like in deep like we are with Reg D or accredited investor fundraising. I will say my opinion about this is that crowdfunding is awesome, could be awesome, but because the regulations are steep and expensive and slow, it is limiting its ability to move faster. And people are trying to chip away at that legislation, those rules, so that they can kind of peel off or knock off some of the really onerous steps or processes so that they can speed up, so people can participate more fully or more quickly. So I don't see crowdfunding moving too much faster than it is by way of number of deals and participants until they change some of those things.
And what are some of those rules that they're considering changing?
One of them would be aggregating everybody into an SPV. That's because companies don't necessarily want all those people on their cap table, or it requires the facilitator like Republic, one of our clients, to kind of aggregate them, even though kind of legally they're all on the cap table, but they're kind of doing some sort of process trick or system trick to make sure that it's very clean and helpful for that company. And so they've done a great job doing that. But yeah, you need, they have limits on the number of dollars. So trying to increase limits, trying to decrease frustration and perhaps kind of ugliness, if you will, when it comes to a company saying, do I really want that? I'm not liking how that feels, or maybe the way that looks, or what I'm hearing. So taking off some of those things that make it so that companies are like, yeah, I'll do that. That sounds great. I think that'll increase the participation.
That's great. What types of things are you doing in relation to cryptocurrency?
So cryptocurrency, it's slowed down a lot from where it was. So 2 years ago, 2018, it went gangbusters, and we are basically doing most everything. And this is some of Assure and our innovation. We would receive phone calls from individuals or groups saying, hey, we're going to do a crypto fund. All the traditional fund administrators would say, no, I don't understand that. I'm not going to do it. Just no. And Assure, we just have a kind of a culture of yes. We just say yes, and we'll just figure it out. And so we were kind of pioneers on taking all the crypto funds, and then all the SPVs that people were putting together to do crypto. The issue with crypto similar to the crowdfunding, there's a lot of regulation, or there's resistance from the government with regards to crypto. So in 2018, we set up SPVs, we set up funds, we did, the books, we did daily or hourly reporting of the valuation of those funds. We did cold storage for wallets, and so that requires, a laptop that's offline, separated from the keys, and so we did that. We did crypto distributions. We took crypto as people's payments into SPVs or funds as their contribution to the deal. We converted crypto. We were part of some of the ICOs to help with those. So we kind of were knee deep in everything crypto. That started to slow, and today we see very little of it. There's still some, but the volume has gone way down. And again, I don't see crypto being as successful until the government stops being really nervous about it. And I'll just give you kind of two stories. It has to be around banking. And so to do an SPV, you need to aggregate all these investors. And so you need to open a bank account or do a fund. But to do a fund or an SPV, you need to open a bank account. And we were on the cutting edge. So we went to the bank and just said, okay, we need an SPV for this. And we showed them all the documentation, and they would just open the bank account. But it took them 6 months to kind of get word from up above, like, we don't do crypto deals. So if anyone's doing a bank account that's going to invest in crypto or anything like that, say no. And so, we were humming and we were doing all these bank accounts, and then they came down and said, don't do it. And so we would then go find a new bank that would say yes, or, they would have all these limitations. And so that bank would allow us, and then they would get something from up high and they would shut us down, say no more crypto. And we'd go find another bank. We had one bank that we had been with for from the very beginning, and had pushed hundreds of millions of dollars through this bank. They went to our website, and our website said that we service crypto clients that are doing deals with crypto. Because that said that on our website, they set off a nuclear bomb on our company with regards to a relationship with their bank. They shut us down. Every account.
Wow.
Every account, doesn't matter, every account, line of credit. They even made us close our PO boxes, our safe deposit boxes. They required us to turn in our keys to the safe deposit box because we had crypto written on our website.
That's crazy.
And so we're continuing to see that even today, where the crypto community is still running into roadblocks when it comes to, I found a business I want to invest in. And then they come to us and we say, well, we can't get you a bank account open. And so there's things like that are slowing down the development of those companies and those assets. And we're seeing far fewer investments going into crypto.
Okay. No, speaking about since we're on I'll come back to crypto in a moment. I know we've had conversations around cannabis investments and the difficulty behind some of those, and I know you enable those to take place. So can you talk about what some of the challenges are in making cannabis investments and how you guys help?
Yeah, it's a very similar experience with crypto. A lot of it has to do with banking. And so if you can't get a bank account together, then you can't take this money in to then go into the company. And so we again have the same problem, but we were again on cutting edge. So we got bank accounts open for a while. Then the banks started shutting those down. And today we do have a bank that will do it if the investment thesis of the company does not touch the plant. That continues to be the line. So if your business idea is going to touch the plant, be it you grow it, you harvest it, you prepare it, no bank will allow you. Maybe there is a bank, but we haven't found a bank that will allow us to set up an investment vehicle for that, be it a fund, be it an SPV. And we see that banks will change their policies all the time. So we always have roughly 3 banks that we're working with at any one time, so that we can bounce between those banks. And that kind of comes with us just being cutting edge, right? We're cutting edge on crypto, we're cutting edge on cannabis, trying to be cutting edge with crowdfunding, and we run into the government regulation, banks that try to keep these investments from happening, and we can usually get around them pretty. We tend to be able to get around them, but every once in a while, we'll get caught between all the banks saying no at the same time, and we won't be able to do it.
That's I mean, it's just impressive, right? That hustle in the background of figuring out the logistics of execution for some of these things. So great sharing that, because so that people leading funds and then also entrepreneurs understand the challenges in that. Um, Taking a step back, because you're in a unique position. All these fund managers all these funds are operating through you. What are some of the trends that you see happening now in venture capital?
So, setting aside COVID and the current kind of environment that we're in, what we're seeing is that fund managers and individuals that want to lead deals and invest in deals, they don't want to be like their father or their grandfather when it comes to raising a traditional fund and building a large, expensive team and managing it in a traditional way. They want to do deals. It's almost kind of like the millennial mentality around, I want it my way, my structure. I want it to be swift. I want it to be efficient. I want it to be transparent. And I don't want to be bogged down with a traditional kind of structure. So what we have seen is micro VCs really be a big part of the community. And, this has been happening for the last 5+ years. We have seen a large number of individuals just going to the SPV model, where they're going to go deal by deal. We've seen a number of people then start to mix the two. So you've got a micro VC fund, which basically a lot of our clients say, I'm not going to take a fee, or I'm just going to take a carry. And so they need to have a group like Assure figure out for them, how do I provide a professional service by way of financials, taxes, capital account statements, distributions? How do I get that professional service without paying a lot of money? And if you have to pay a lot of money, then you need to raise a lot of money and do a management fee. And if you do a management fee, then you kind of are chaining yourself to the desk that says, hey, I'm paying you this management fee as an investor. I expect 100% of your attention to be on this fund. I expect you not to do anything else until this fund wraps up. I expect you to behave in certain ways. And the next generation of investors are saying, I don't want that. I don't want to be chained to my desk. So I don't want the fee, but I do want to do deals. I want to build relationships. I want carry. I want success fees, but not necessarily day-to-day management fees. And so they find, Assure creates products for them to say, okay, let's get you a minimal level of professional services for your LPs, because that's the right thing to do. And giving you that structure and the product that you want to provide to your investors and to the investing community. And so micro VCs that don't look anything like a traditional fund, SPV deal by deal. And then there's something that we call a multi-asset SPV, which is a little bit of a hybrid between the two, where you're adding kind of 3 or 4 investments into one vehicle. Maybe it's over a demo day weekend, and you're going to pick 3 or 4 and put it into a little fund. No management fee, no financials, no audit. Everybody kind of knows what you're going to do. And so there's just these new products and these new structures that everyone's kind of gravitating to do deals, but not necessarily be in a traditional sense. But there's nothing wrong with the traditional sense. There's still a number of people that like that route, but we're seeing far more individuals of the next generation not wanting to sign up for a 15 to 20 year commitment to a fund by raising 20 or 30 or $50 million. They want to have a lot more flexibility and optionality with their investing career, and thinking about it far more, kind of year by year, rather than saying, I'm going to do this for the next 20 years.
Yeah, absolutely. I think in looking at, uh, I mean, it's with the micro funds, right? Have I think they're over the last several years have increased. I think according to the Kaufman Foundation, 9x in terms of the number of funds. Um, I think there's a few investor groups that are doing unique. They're pulling together a fund in what is it, the alumni venture group, but pulling
Yep.
together individual funds and executing them over a year rather than the longer period. So interesting models arising. Um, any other models that you've seen that you found very interesting that have come up?
Um, I think they're all kind of a hybrid of each other. So you've got like a micro VC fund that is going to invest 100% of their capital and then do SPVs for those funds or those companies that show promise. You know, when I ran the Utah Fund of Funds, that was heresy to say anything like that. You know, you would be run out of town if you did not reserve, you know, X percentage of your fund for follow-on investing, and to have people say, no, I'm not, I'm reserving zero. I'm going to invest 100%. I'm going to invest in 50 startups, and then I'm going to see which ones are successful. I'm going to do deal by deal SPVs for the winners, right? Like things like that are just unheard of five years ago. And I think a lot of it has to do with Assure and some of the structuring options, because years ago, an SPV would cost the same as doing the fund.
Uh-huh. Yep.
Same cost, same time. It would be prohibitive for you to have that strategy. So today, you know, as we change that product and provide that product, people can now make new decisions with regards to the structure, the thesis, and the strategy, and how they want to invest in startup companies.
And can you share a little bit more about that now, since you're on that topic, with the products and services that you all have come up with in order to bring down the costs and enable some of this innovation?
Yeah. So kind of it took us a good 8 years. We're in our eighth year of working on these SPVs. And like I said, you know, each aspect of the service we provide is very chunky with lots of moving parts and difficulty. And so when we first started, it was really like, could we even just do this like kind of manually and keep track of it? We then started to build technology where we took those things that took the longest, that were the hardest, maybe the worst experience for our clients and the investors. And so we started to build technology. So now we have a platform called Glassboard that smooths out the onboarding and investing and setup and closing experience, and that's going to be continually developed. And you know, ultimately for Assure, our mission is to nearly eliminate the structuring and admin expense to investing in startups or any other private asset for that matter. And
Awesome.
what we mean by that is there's a lot of times when people don't do investments, they don't invest in a startup company or some other project because the structuring and admin is too expensive. And so what the way we want the world to run is the only decision that you're making is this a deal that fits my thesis, my return profile, my morals, my standards. And if the answer is yes, then you move forward. You would never stop and say, but the structuring's 10 grand and the admin's 50 grand. And, you know, I don't think we can raise 2 million, or, you know, those decisions are gone. You just go to Assure's platform, click a couple buttons, you have your entity, and you move forward. And the way we do that is by continuing to chip away at the traditional nature of doing structuring and admin for private transactions. And today we released, it was a good kind of 6 months ago, a product called Assure Labs, where we basically charge a few $1,000 plus 1.5% of the raise, which allows people to do really small deals like $50,000 deals, $30,000 deals. And, you know, we actually had one client do a deal where they raised $18,000 total, and they used Assure to provide the structuring, the security filings, the taxes. I mean, everything that we provide, we're going to provide it for that SPV. And ultimately, we want it where the computer does a lot of it or all of it. And then if you want to pay extra, you can, get an expert to help you. But to basically maybe pay a monthly fee and do all the deals that you want. Maybe deals are free and you're paying for some other service, but we want to basically remove all the structuring and admin expense when it comes to doing private investing.
That's great. That's and it's enabling a lot of creativity. I was gonna say when you were talking about the preference of the new generation making microfunds, I think there's also it's twofold. I think some of them don't know where to get all the money from these LPs. So
Yes, that's a big element. And I would say it's the hardest element. And there's work there. So just like any other business that you start, there's work, and finding investors and having them trust you is a big heavy lift. But part of that also is, when you bring a deal and you have structuring and admin costs on top of that, that decreases the potential returns. And so as those things get eliminated, some of the barrier of investors' interest or their hesitation uh, goes down, because there is not an extra hurdle to get over when to get their money back. And so, if you basically can go to and say, there is no fees on this thing, I'll take a carry if there's profit. So every dollar that you put in goes to the company, and then we'll settle up with some carry only after their success here. That helps people be relaxed, and so that can help people invest. But this still is a relationship business when it comes to finding deal flow, finding investors, accepting money. It's still a relationship business, and I don't think that's going to be going away anytime soon.
Absolutely. And on the topic of LPs, for those that aren't familiar that are watching, LP is limited partner. Those are the ones that provide the capital that venture capitalists then go out and put into startups. Can you share a little bit of what you're seeing at that level? Of what's happening in the market now.
Yeah.
You can include, in terms of COVID and all that's happening. Are yeah. What are you seeing?
Yeah. So I lived through the 2008 crisis, and when that happened, there was what we kind of called a pause, where everybody, I call it kind of check for bleeding. What's going on with my portfolio, my real estate, my stock, my bonds, my private assets, and so wondered if similar behavior would occur during the next downturn, and that's here today with COVID, and they're all different. All these downturns and whatnot are different, have their own flavor. But what we're seeing in the marketplace is there's three types of investors. The first one is someone that's backed out, so they're just like, I'm done. I'm either they're checking for wounds, they are checking for blood, they're wondering should they continue or not. They're pausing. They basically have stopped returning phone calls. They're not going to do any deals right now. The other one is somebody who is still interested, but they've decreased their allocation. So they still want to be in, but maybe they're feeling a little overexposed, or they're being careful with their cash. So before, maybe they're putting in $10,000 checks, maybe they're putting in $2,000 checks now, or something like that. So they're in, but only one foot. And then there's another set which are still in. It's like nothing happened. They're still all in. Those tend to be family offices, tend to be individuals that are extremely seasoned, and they know exactly what they're doing. They've been through other recessions and downturns before, and they know what they're looking for. The casual investor that's like, I'll just sprinkle it around, and this is kind of fun. Those tend to kind of disappear during crisis time. And so deals are still happening. At Assure, we see the volume of deals happening, and we've seen a decrease, but it has not shut off. So we're still seeing a good 60, more than that, about 70-75% of what we were before is still happening. Mm-hmm. And then there's also certain strategies that become more attractive during this time. And so there can be an increase in deals in certain strategies, maybe secondaries, maybe distressed. other things like that. So we do think there's a pause going on, generally. There's a slowing going on generally. There's really questions about valuation. There's strategy now going on saying, well, if I wait, should I wait? Will the valuation go down? Will I miss out, or will it still be here in a couple months? Should I see if they survive? Or is this exactly what I've been looking for? And I didn't think I was going to get access. And now there's this rare opportunity to get in. So I need to jump right this second. So it just depends on the company, the strategy, the investor. But so deals are happening. There's moving slower. The raises are smaller. I think there's more scrutiny, but things are still happening. We anticipate that the PPP will play a role here. We don't know exactly, but basically startup companies in theory maybe got their next round of funding from the federal government.
Mm-hmm.
And so they're not as desperate. So valuations don't come down right now. And it could be that, the COVID-19 virus makes moves or lingers or spikes or something like that. And that changes everyone's opinion or moves the market. And the final thing that really affects the investors is the stock market. As much as we kind of wish it didn't, everybody tends to have a portfolio of public stocks. And when that drops, one of two things happen. One, they feel less wealthy. Two, they can feel out of allocation percentages and they start to feel upside down with regards to the strategy that they built. Or three, they think that they would rather spend their money on a public stock. So if they believe in a certain company, that stock is decreased 30%, 50%, 80%, and they truly believe in that company's strategy and economics and future, they'll take money out of their private company investing bucket and they'll move it over and start buying, one of these public shares that obviously has some different aspects and elements to it than the private companies do. So those are tend to be what happens in these types of environments. And you just kind of have to wait it out for things to come back to whatever normal looks like.
No, and speaking of that, if we were to take a step back with everything, I mean, there was always a trend to go digital. You mentioned there's a relationship. This is a relationship business. You're speaking to people. You're moving money. It's people's money that there's trust engendered there. What do you see 10 years from now? What are some things that you see? Where do you see the market trending? What do you see changing, if anything?
Well, what I think is interesting is the new generation that tends to be millennials and younger. They don't value the face-to-face, and this is my opinion from what I've experienced, as much as the older generation. My generation and older, they really like that, come to their office, shake their hand, go out for drinks, have a coffee. That really means a lot to them, and it sometimes is a necessary. What I have found is I've had clients sign up with Assure through email. And I just email me, like, tell me about your product. And I'm like, hey, you want to jump on a call? They're like, no, just email me. Email back and forth. They're like, hey, I'm signed up. Let's do this, which is unique and different for the older generation. And so what I have found is that the younger generation, does he trust this person? If I trust him and he trusts Sally, I'm in. And that's how it kind of goes today. And that's how Assure has grown through referrals. People just say, I use Assure. And then people just go, okay, then I am. I don't need anything else. Larry believes, I believe. And so I think that's the future, at least for the next couple of generations, which is digital, is, you'll have some core strong relationships. And then if they make a recommendation, they're good. And I think that's how the next 10, 15 years are going to go.
Of investing. No, that's great. Thank you very much, Jeremy, for your time and for sharing your insight on the market with us. So everyone who's watching, Jeremy Neilson, co-CEO of Assure, thank you for joining us tonight.
Thank you.
So this has been Rebel One Live. Join us every week. We're here Tuesday through Thursday at 7 p.m. So thank you.